So, how do you prevent fraudulent reporting, such as through a management override? Is it just a matter of having the right people and the right policies in place?
Well, when that kind of thing happens, that is to say, when there is judgments that need to be made in the application of the accounting, and the senior executives decide here's how we're going to make the judgment, yeah, that can be management override. So what you need, Becky, to come back to your earlier point, what you need is not simply an accounting policy, but you need the discipline of application of that accounting policy. You need the right people making the judgments quarter after quarter. You need the right information to assist in making those judgments to minimize the opportunity for judgment calls to be made in such a way that loses their objectivity.
When it comes to fraud, you always tell me, Mike, that there's very little new under the sun. And I recall that approximately 40% of all fraudulent reporting involves revenue recognition. Will organizations be in better shape next year when they translate the standard setter's new guidance on revenue recognition into accounting policies?
Well, it certainly helps. And I expect lots of companies are revisiting their revenue recognition policy right now because FASB's come out with a new standard and we've got to get ready for it. If you can have a good, well-written, understandable, plain English accounting policy governing, say, revenue recognition, you're off to a much better start than if you don't have that. But Becky, the point that I would make is that that's not enough. It's not simply enough to have an accounting policy because some accounting policies will necessarily need to take into account judgment. Revenue recognition, for example, the level of judgment that's necessary under the new standard is probably going to increase. An accounting policy is a strong starting point, but it's discipline in the application of that accounting policy that can make a big difference.